Invest and earn up to $2,000 in bonus silver at goldsilver.com. It's easy. Step 1. Open any gold-silver storage account excluding IRAs. Step 2. Purchase your precious metals. Step 3. Get up to $2,000 in bonus silver dropped straight into your vault. Visit goldsilver.com/free silver to claim your silver.
Hi, everyone. It's Mike Maloney and Alan Hibbard once again with the Gold Silver Show. Let's get into it.
Yes, exactly. So I know a lot of people are getting interested in gold these days, and I thought what we could do is go through the In Gold We Trust report put out by Incrementum and look at a handful of the charts that really summarize what is going on in the gold market these days and what is sort of the main thesis for why someone would want to buy it.
Okay. Before you get started, I just want to point out that you said a lot of people are getting interested in gold these days. A few in the West are getting interested. Mostly it's coming from the East, and I believe you're probably going to present some information in here that will end up proving that.
We'll see. Yeah, I guess it's all relative, right? So let's get into it. Right. This is the In Gold We Trust report. They publish a long one that's over 400 pages and a short one that's like 40 pages. And in this video, we're going to condense it even further down to like 5 or 6 charts that sort of summarize the main thesis. Okay. So if anyone wants to read this, it is free online.
Yeah.
So the first chart here, gold in US dollars and new all-time high closes going back to 1970. So this is the price of gold, and all the blue dots here are all-time highs. And you can really see the shape of bull markets. They tend to go vertical and get steeper and steeper and steeper as you go. All those dots start to pile up. What do you see in this chart here, Mike?
One of the things I see, at first glance, you're saying, okay, this 2020's bull market is only 76 all-time highs. So basically, compared to 209 of the 70s, we're just getting started. However, I do want to point out that they split today's bull market into 2 sets of all-time highs, where they have grouped the 70s bull market into just one set. So you'd have to take the 106, add 76 and 106 together, but still, it doesn't matter. The global economy is in a lot more trouble than it was back in the bull markets of the 70s. And gold being a monetary asset, it's really when monetary demand hits, and we haven't had it yet. We've got fear of missing out, which is completely different. That's greed-driven, not fear-driven. And we've got some people getting prepared because they see something dangerous in the road ahead, but not that many. So as a percentage of the population, not that many. Not enough people own gold yet for this to be anywhere near being over with.
Exactly. And for anyone who doesn't know, at the very end of this bull market in the 70s, the price of gold doubled in 42 days. So it went real vertical right at the end in 42 days. So that hasn't happened yet in the current bull market, but something like it probably will, I think, at least. So I think we have a lot more all-time highs to go. I think we're still going to keep going for a little bit of time here.
I think we absolutely have more than a double in gold. I think that, if I had said that $10,000 was possible when I wrote my first book back in 2007 and 8, it came out in 2008, but it was written in 2005, 6, and 7. And if I had said that $10,000 was possible, everybody would have called me absolutely crazy. But one of the things that I've put in both books is that, at the beginning, back in the early 70s, when gold was just leaving $35 an ounce, a lot of economists thought that gold was going to fall in price, not rise, because there wouldn't be any more central bank demand now that it was demonetized, basically. And anybody that predicted that $100 was possible was considered an absolute lunatic. And if you said $200 was possible or $400, it was like tie him up and put him in a rubber room, because this guy is really crazy. And we ended up going to 873 intraday. So anyway, early on in bull markets, people point to the people that end up being very accurate, the ones that were actually right, and calling them crazy. And so I still think that there is a lot more room to run.
I agree. And one thing to remember, people are used to the stock market where you get the biggest move first and then smaller and smaller moves until it levels off. Precious metals work the opposite way. You start with really small moves, then you get the medium moves, then you get the biggest moves at the end. So it goes the opposite order you're expecting. So
I want to encourage everybody once again to just get the Kindle version of the book if you want. It's $9.99 for Great Gold and Silver Rush of the 21st Century, because in there is a section of there's a chapter that compares the bull market of the 70s with the bull market of today, which we are doing in this chart. But there's a section of that chapter that's all about Giffen goods. And one of the things that we do is, I've been showing this for years, but it sort of goes over people's heads. If you take a chart of gold and turn it upside down, it looks more like a chart of the stock market. The stock market has these round distribution dome tops and these real sharp crashes and V bounces that are fear-driven. Gold, it's fear-driven toward the tops. And so you've got these spiky tops that it really does look like an upside down. The gold looks like an upside down stock markets chart. Stock markets look like an upside down gold chart. And it just shows that the dynamics of fear and greed are very different in these two asset classes.
Exactly. So anyway you look at it, we got more to go. All right, next chart here. Accumulated gold ETF holdings compared to the price of gold. And you can see that they follow each other pretty nicely, except the last couple of years, ETF holdings have leveled off, even dropped a little bit while the price of gold has been rising. So that split's been going on about 2 years. So what do you make of this divergence here, Mike?
Well, the problem here is that the source is World Gold Council and Incrementum AG. And I don't know, did they include ETFs in China and so on? Most likely they don't have that data, because the gap between those is most likely made up by people in the East. It's investment coming from China, and then the wedding season in India, and so on. And so there's something going. There's two things going on here. That plus central bank buying. That could be one of the reasons for that gap, because the ETF holdings isn't what is putting a floor underneath gold. It's definitely coming from elsewhere. And so this, at the beginning, I said that it wasn't people. You said that more people have had interest in gold lately. Yeah, a few Westerners, but not that many. It's mostly Asia that was driving this, and I think this is the chart here that sort of shows that it's coming from somewhere else. It's not coming from the retail investor in the United States.
Yeah, exactly. And to your point about central banks, yes, central banks have been net buyers of gold since around 2015, 2016, around this bottom here. And I think they're the ones providing the tailwind for the price of gold for the last 10 years. And that's actually what our next chart is, central bank gold purchases.
Okay.
So you anticipated that nicely. And we have it going back to 1950 here. So you can see a lot of color on this chart, a lot of different periods we have. So central banks were net buyers of gold here, and France repatriated over 3,000 tons of gold. Charles de Gaulle, and that's basically what led up to the Nixon shock in 1971.
Well, it also led up to that collapse of the London gold pool. So for any viewers that don't know, the London gold pool was a group of central banks led by the United States. And whenever gold would rise to a significant amount, like when it got up, if it was supposed to be $35 an ounce, that was the official price. That was the price that central banks traded it for. But when the free market price rose above that, and there was a significant enough price differential, this group of central banks, led by the United States, would dump a bunch of gold on the market to cause the price to go down. And it was absolutely emptying the coffers, and United States was the largest contributor to this because we had the largest stock of gold, and it really did suck a lot of gold away from the United States. And that collapsed as soon as France pulled out and started repatriating. So, okay, and that is what caused. So these three first events are a chain reaction. That is what caused the Nixon shock. Nixon had to take us off of the Bretton Woods system, which was the last connection to some sort of pseudo-phony gold standard, where we only had about 8% gold backing at the time. Because if gold kept on flowing out of the vaults, because under the gold standard, any central bank, any foreigner actually, was allowed to show up at the New York Federal Reserve, and they actually had a window where they would pay out gold for U.S. Federal Reserve notes. So you could cash in your Federal Reserve notes for gold at $35 an ounce. And gold was leaving the United States because of that, because of this chain reaction of events here. It's very interesting. Okay. Yeah. And then, UK and Switzerland. So the UK sold almost all of their gold, right? He's got a very large rectangle there of gold central bank sales. I don't know which ones. It would be interesting to just isolate the UK, but I mean, they call it Brown's Bottom. Gordon Brown, I think his first name was Gordon, was Chancellor of the Exchequer or something like that. I can't remember his title. And they sold half of all of their gold at the very bottom, down in the 250s. Brilliant, huh?
Yeah, that's not good. No, you want to buy low, sell high. Maybe he missed that day.
Right. And so they sold it all at 250, and now they're buying back at 3,000.
Anywho, so then basically after the global financial crisis, central banks started buying a ton of gold. So, and then after COVID, they started buying even more. And of course, Russia invaded Ukraine, and we've had the asset freezes and seizures. And now gold purchases are accelerating by the central banks. But to your point,
if you overlaid that last chart with this, the divergences are largely driven by this, most likely. So, I'm sorry I interrupted. What were you going to say?
I was going to say, to your point, Mike, central banks are buying, but a lot of retail investors are still sleeping. They're not there yet. So,
yep, right.
Hopefully they'll join the party soon.
Well, it's best to be early than a minute. It's best to be a year early than a minute too late. So,
exactly. So, with all these central banks buying gold, like, one has to wonder, what are they going to do with it, right? And what's going to happen to the monetary system, either in the United States or globally? Well, Scott Bessent, Secretary of the Treasury, he said, I could see in the next few years that we are going to have some kind of a grand global economic reordering, something equivalent to a new Bretton Woods, or if you want to look further back, something akin to the Steel Agreements or even the Treaty of Versailles. There's a very good chance we'll need this within the next 4 years, and I'd like to be a part of it.
Yep. Okay, so we made some videos on this, and I was in Arizona back in April. I believe this is a February or March statement by Scott Bessent, and I pieced this together with several other statements, some from President Trump and more from Scott Bessent, that sort of point toward, if this happens, something equivalent to a new Bretton Woods, it's most likely a global monetary system that's connected to gold. And it can't be at these prices. It's got to be at far, far higher prices than where we are right now.
Exactly.
Yeah. And so there's a series of videos. If people look back into March, April, May timeframe, you'll see these videos on the possibility of a coming gold standard. And the evidence is there. And one of the things that was interesting is if you listen, I think it's in this, it might be, it's a different interview than this, where Scott Bessent, when you put these all together, Scott Bessent and Trump basically said gold, 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 not Bitcoin.
Mhm.
Bessent basically said Bitcoin is a risk-on asset. Gold is a risk-off and a risk-on asset. And so basically, when everything is going well and you want to take gambles, those are risk-on assets. Risk-off is where you run for a safe haven. So those are his words, not mine. So for the Bitcoiner out there, I just want to say that's Scott Bessent's take on it, the Secretary of the Treasury.
Yeah, exactly.
Okay.
And he came out recently in a recent interview and said that they're not going to be buying Bitcoin for the strategic Bitcoin reserve. They're just going to be confiscating it from criminals.
I don't think they ever called it the strategic Bitcoin reserve. They called it it's a strategic crypto reserve. But did they ever use the word Bitcoin? Because when they established this thing, I thought they specifically said that they are not going to be buying any new Bitcoin.
They actually created two different entities. One is a strategic Bitcoin reserve, and they have legislation in place to never sell it. And then they have another one that's a digital asset stockpile. And I believe the language is they will develop strategies for responsible stewardship, which doesn't prevent them from selling it. That's where they're at. But he did come out recently and say that they're not going to be buying Bitcoin with taxpayer money, probably because they can't come up with a revenue neutral way to do it. But he did say that. So the implication is that they will only have Bitcoin from confiscating it from criminal proceedings. So that's where we're at with that. So go ahead and get your gold before they revalue it. Yep. Here is the U.S. M2 money supply per capita. So this is per person in the U.S. going back to 1900. So of course the population grows over time, and I believe it's grown by a factor of 4 or 5 since then. I might be wrong about that, but the M2 money supply per person has obviously grown much faster. If they kept pace with each other, this would be a horizontal line. It would be perfectly flat if the currency supply grew at the same rate as the population. Obviously, it's growing exponentially. This is over 500 times larger. So, every time we get a new person, we get $500 more dollars. Like it's crazy. This is growing way too quickly.
Yes. Okay. So it would be interesting to plot this growth against inflation, except you'd have to pick some sort of mean between the way the government used to measure inflation and the way they measure it today, because we've shown lately the difference between the shadow government statistics, alternate CPI, which is the original way that the U.S. calculated inflation, and then the way that they keep on fiddling with it. Every few years they change their methodology of calculating inflation just to massage the numbers and make them look a little bit better to everybody. But it would be interesting to plot these, because this is where the inflation comes from. Ultimately, there are short-term changes in velocity and some other things that cause inflation and lack of inflation, but ultimately, this is where it comes from. And you said if it grew equally with the population, it would be a flat line. Well, that's what gold does. We make babies at about the same rate that we mine gold, and that's the reason it has constant purchasing power. Not absolutely flat. It goes up and down inside this valuation range. But you go back to ancient Rome to today, and there's a range of purchasing power that gold has. Okay, so what's next?
Yep. We have the shadow gold price at different gold coverage levels. So basically, with all that M2 currency creation, and of course M0, M1, right, all the different measures you want to use, currency has been exploding. So if the price of gold were to be adjusted either by the free market or by a new monetary system that revalued it, the question is, what price of gold would it have to be revalued to so that the price covers the amount of currency that's been created? So this chart is showing 6 different examples, 6 different possibilities. So I'll walk everyone through them one at a time here. So if the price of gold covered 25% of M0, the price of gold would have to be $5,100 per ounce. Okay. If it covered
Yeah.
40% of M0, it'd have to be about $8,000 per ounce. If it covered all of M0, $20,000 per ounce. If it covered 25% of M2, like about 58,000, 40% of M2, 92,000, and all of M2, $231,000 per ounce. That of course is absurd. So yeah, Mike, what do you think would be a reasonable level of coverage here?
Well, first of all, M0 incorporates a few different aggregates of the currency supply. What gold backs currently in the monetary system and historically is only the currency in circulation. It backs the Federal Reserve notes. So trying to calculate what it would have to be if it was to cover M2 is absolutely pointless. It's ridiculous because the Federal Reserve does not guarantee all of the bank credit that is created. It's not going to ever cover bank credit. So for anybody to run these calculations of, well, what would it take if gold covered the currency supply? Well, I believe it's about 92% is created by the banks and not the Federal Reserve. And so you have to eliminate that. So those blue bars are basically a pointless exercise. It's never going to happen. It won't. If right now, almost all, how much did we calculate? It was like 99.7% of all America's gold was pledged to the Federal Reserve. And so they have basically a lien on America's gold. And those gold certificates, which could be revalued under this new system that Scott Bessent was talking about, and something like this, I think this might be in our future. It's going to be a giant shock to the global monetary system if it happens. And it's only really going to happen if there's a major crisis, but I see a major crisis coming. So historically, we had treasury notes, 100% backed by gold. So if you had a note, that was the IOU. If you had a dollar bill or a $20 bill, that was the IOU from the treasury. And it said there have been deposited in the Treasury of the United States $20 in gold coin payable to the bearer upon demand, right on the note. And so that was the IOU. And gold standard is self-funding. A gold mining company digs up a bunch of gold, sells it to the Treasury, and the Treasury buys it just by creating the IOUs for it. So they print the currency, and then the gold that they just bought backs the IOU. So it's a self-funding process. It's nothing that has to be taken out of taxes or anything else. But the 40% is the ratio that fell apart during the Great Depression. When the Federal Reserve was established, we went from a 100% gold backing of the currency, the IOUs, to IOUs that were only 40% backed, meaning 60% of the IOUs were fraudulent, that this was a lie. And that's what caused it to fall apart, is because they were lying. So if they pick a 40% reserve ratio, this is the reason I've always said, gold standards suck. Gold is great, but gold standards suck. The lie is what fell apart. And then they didn't establish a by law reserve ratio for the Bretton Woods system. And they just kept on creating currency, and it fell to about 8%. But basically, you and I already did this calculation in one of our videos from April or May, but it was $9,044 to cover 100% of the currency in circulation, not M0. So by now, maybe we're very close to $10,000 an ounce to cover, to go back to what historically was the portion of the currency supply that the U.S. gold covers. But the U.S. gold, the gold that is supposed to be held in trust for all of the U.S. citizens, is not going to be used to back private bank credit. Banks, they have some rules that they have to live within. And the Federal Reserve can tighten up those rules or loosen up those rules, but there are rules that govern that. But the U.S. has never guaranteed the bank credit that they create, and that's most of the dollars that exist.
Yeah. So you're thinking $9,000 or $10,000 an ounce would be enough to cover currency in circulation, and we may overshoot that temporarily if it happens due to free market factors.
That free market factors plus how much headroom does the government want to be able to do deficit spending? Because this really puts a constraint on everything. How much currency you're going to create. They're talking about gold-backed bonds, and they used to have gold-backed bonds before everything fell up. Before Roosevelt made private ownership of gold illegal, they had to abrogate, it's called, the gold clause in all of the U.S. Treasury bonds that said they were redeemable in lawful money, which included gold coin.
Yeah, no more lawful money, not in this country.
Right. Right. So for anybody that wants proof of this, just go to the Federal Reserve's website or just do an internet search for Federal Reserve H.4.1 release and scroll to the bottom, and you will see that the only place on the Federal Reserve's balance sheet that the U.S. gold is being used monetarily is to back currency in circulation. That's the last item on the H.4.1 release. And if you take the number of ounces that we've got divided by the currency in circulation, you need $9,044. At least that's what it was when we made a video about it recently, to back the currency in circulation. And that is what they did historically.
Well, we got one more here. Comex gold deliveries in thousands of troy ounces, and you can see that there's a long-term trend that's relatively low of how much gold is delivered, and then it spiked here a few years ago in the COVID era, and now it's ticking up even more the last year or so. So wow. A lot of gold being delivered off of Comex.
Yeah, this is these are a few smart people that are worried. And they're just getting right to the front of the line, and basically they're not holding the IOUs anymore. That's the difference. The ones that don't take delivery are just holding IOUs. Will those IOUs be any good in a crisis? Who knows? Yeah,
exactly. And speaking of IOUs, do you have enough non-debt money, Ray Dalio? Right?
Okay, so I hope Ray joins the party. That years ago, when Robert Kiyosaki first put me on stage in front of a large group, he had put me on stage 3 times in front of 300 people. And then I went to ask him if I could be the Rich Dad advisor for precious metals. And he said, "You've got to write a book first." And we were meeting backstage at the Los Angeles Convention Center. And this was during a break, right in the middle of this conference where he was speaking. And so everybody was out in the hall having lunch, and then they were coming back into the speaking hall. And you could hear his name being said over the loudspeakers. And he goes, "I've got to go out on stage now, but I'd like you to wait back here, and then I'll bring you out and you can tell them when Nixon took us off of gold in 1971. And when he introduced me, so I'm waiting backstage, and he introduced me and he goes, "In 1971, the dollar ceased being money and became currency." And I went, bing, oh my God. And I started researching this, and I'm like the only one that really went after this. He started referring to the dollar as money, but that was basically the day that I stopped, when I researched it and found that, that the key attributes are, it's got to be a medium of exchange, it's got to be a unit of account so that you can put prices on things, and a store of value. And if you do an internet search right now for what are the key attributes, what are the key attributes that something has to have in order for it to be called money? Even on the Federal Reserve's website, the Federal Reserve says the most important attribute is that it's got to be a store of value. Well, it's lost 99% of its value since the Federal Reserve took charge of it. Aristotle was the first one to define these characteristics. And so you're talking a few thousand years. We've known this. What something has to do, its functions, has to be before it can be called money. The dollar does not qualify, nor does any national fiat currency. If it's debt-based, it is not money. So do you have enough non-debt money? Well, if it's money, it isn't debt. So basically, you can draw a line between the word debt and money, and there's money is non-debt.
Yeah,
and so,
exactly. So this is redundant.
Right.
This is redundant.
Right.
Exactly.
Do you have enough money instead of currency? That's the point, right?
Exactly. I agree completely.
One of the things that's interesting is a lot more people have been defining the difference between money and currency. And I've been fighting for this for more than 10 years now.
Yes. Fight the good fight. I love it. Well, thank you, Mike, for doing all that. So for anyone who is a little bit unclear what we've been talking about here, we have gold at all-time highs, but not quite as many all-time highs as it used to have. We've got ETFs, a divergence between ETFs and the price of gold. We've got central banks buying a ton of gold, and the Treasury of the Secretary talking about a new monetary system. He thinks it's going to happen, and he wants to be a part of it, and he thinks it's going to be gold. So what does that all spell? Well, it spells our meme of the day. It's a fill in the blank meme, because you have to answer this for yourself. What are you going to tell your children when they ask you, did you buy gold, Daddy? Did you or did you not?
Yeah. And what you want is that positive response down at the bottom there. Legend. Yeah. Awesome. Okay. I want to thank you, Alan, for this presentation, and thank everybody for watching. We'll see you later.
Invest and earn up to $2,000 in bonus silver at goldsilver.com. It's easy. Step 1. Open any gold-silver storage account excluding IRAs. Step 2. Purchase your precious metals. Step 3. Get up to $2,000 in bonus silver dropped straight into your vault. Visit goldsilver.com/free silver to claim your silver.